One mistake with your survivor benefits could cost you more than $100,000 over your lifetime, and most widows never even realize they made it. That is not a guess. That is what happens every single day in Social Security offices across this country. Widows walk in during one of the most difficult seasons of their lives. They are grieving. They are overwhelmed. They are trying to figure out how to move forward. And in that fog of loss and confusion, they make decisions about survivor benefits that seem right in the moment, but end up being quietly devastating for decades. The Social Security Administration will process your claim. They will be polite. They will follow the rules. But here is what they will not do. They will not sit you down and explain every option you have. They will not map out the timing strategies that could add tens of thousands of dollars to your lifetime income. They will not tell you that the choice you are about to make might be the wrong one. That responsibility falls on you. And today, I am going to make sure you have everything you need to carry it. We are going to walk through the most common errors widows make with survivor benefits. Not the obvious ones that anyone could spot, but the subtle ones. The ones that feel like the right decision. The ones that seem logical but end up costing you dearly. And more importantly, we are going to talk about how to avoid every single one of them. If you are a widow, this could change your financial future. If you know someone who recently lost a spouse, please share this with them. The information here is too important to miss. Let me start with the most widespread mistake of all: filing for survivor benefits too early. I understand why this happens. A husband passes away. The bills keep coming. The income that used to arrive each month suddenly stops. And there sits the survivor benefit, available as early as age 60. It feels like a lifeline. It feels like the obvious next step. But here is what many widows do not realize. If you claim survivor benefits at 60, you are locking in a permanent reduction of 28.5%. That is not a temporary adjustment. That reduction stays with you for life. Let me put real numbers to this. Say your full survivor benefit at 67 would be $2,400 a month. If you claim at 60, that drops to around $1,716. Every single month for the rest of your life, you receive nearly $700 less than you could have. Over 20 years, that difference adds up to more than $160,000 gone. Not because you did anything wrong in the traditional sense, but because you made a decision without understanding the full picture. Now I want to be clear. Sometimes claiming early is the right choice. If you have no other income, if you are facing genuine hardship, if your health situation makes waiting unrealistic, then early filing might be necessary. But it should be a conscious choice, not a default one. You should know exactly what you are giving up before you sign those forms. And that leads directly to the second major error: not understanding that you might have to separate benefits. This is where things get interesting and where the real strategy begins. If you worked and paid into Social Security during your career, you have your own retirement benefit. That benefit is completely separate from your survivor benefit. They are two different pots of money, calculated differently, with different rules and different timing options. Many widows do not realize this. They assume survivor benefits replace everything else. Or they think they have to choose one and lose the other forever. Neither of those things is true. Here is what the rules actually allow. You can claim one benefit first and switch to the other one later. This is called a claiming strategy, and when done correctly, it can add thousands of dollars to your lifetime income. Let me give you an example. Meet Patricia. She is 62 years old. Her husband passed away last year. Her own retirement benefit at full retirement age would be $1,600 a month. Her survivor benefit at full retirement age would be $2,200. If Patricia just walks into the Social Security office and files for whatever they offer her, she might end up with a reduced version of one benefit and miss out on maximizing the other. But if she understands her options, she can do something smarter. Patricia could file for her own reduced retirement benefit at 62. Yes, it will be smaller than if she waited, but here is the key. That choice does not affect her survivor benefit at all. Her survivor benefit continues to grow untouched until she decides to claim it. Then at full retirement age, 67 in her case, Patricia switches from her own benefit to her full survivor benefit. She gets the complete $2,200 with no reduction. And she has been receiving income the entire time. Compare that to a widow who claims the survivor benefit early at 62 and locks in a permanent reduction. Patricia ends up with significantly more money over her lifetime simply because she understood the two-benefit rule. This is not a loophole. This is how the system is designed to work. But almost no one explains it clearly, which is why so many widows miss out. Now let me address the third common error, and this one surprises a lot of people. Assuming the Social Security office will tell you the best strategy. They will not. And I want to be very careful here because the people who work at Social Security are doing their jobs. They process millions of claims. They follow procedures. They answer the questions you ask. But they are not financial advisors. They are not required to show you every option. They are not going to sit down with you for an hour and map out whether you should file now or wait, claim your benefit first or the survivor benefit, or consider how your tax situation might change. I have heard from widows who filed in January 2025 and only learned months later that a different strategy would have given them hundreds more each month. By then, the window to change course had closed. The decision was made. This is why preparation matters so much. Before you ever walk into that office, you need to know your own retirement benefit amount at different ages. You need to know your survivor benefit amount at different ages. You need to understand how those two numbers interact and which claiming sequence makes sense for your situation. If that sounds overwhelming, keep listening. We are going to make it simpler as we go. The fourth error widows make involves timing, but not in the way you might expect. Missing the retroactive payment option. Here is something that can actually work in your favor if you know about it. When you file for survivor benefits after reaching full retirement age, you can request up to 6 months of retroactive payments. That means Social Security will pay you for months before you actually filed. This is real money that some widows leave on the table simply because they do not ask. Let me give you an example. Say Margaret reached her full retirement age of 67 in January 2026. Her husband had passed away a year earlier. She finally files for survivor benefits in June 2026. Because she is past full retirement age, she can request that Social Security pay her retroactively back to January. That is 6 months of benefits, potentially $12,000 or more, that she gets in one lump sum. But if Margaret does not know to ask for this, she might only receive benefits starting from June. The money she could have claimed simply disappears. Now this option has limits. You cannot get retroactive payments if you file before full retirement age. And the maximum look-back is 6 months, even if more time has passed. But for widows who are past full retirement age and delayed filing for any reason, this is money you are entitled to. Make sure you claim it. The fifth common error is one that catches widows completely off guard. Not understanding how working affects survivor benefits before full retirement age. Social Security has something called the earnings test. If you are receiving benefits before full retirement age and you continue to work, some of your benefits may be temporarily withheld based on how much you earn. In 2026, the limit is around $23,400. If you earn more than that, Social Security withholds $1 in benefits for every $2 you earn above the limit. This creates a painful situation for widows who are 60 or 62, receiving survivor benefits, and still working. They might expect a certain amount each month, only to find that a portion is being held back. Now here is the nuance that many people miss. This money is not truly lost. When you reach full retirement age, Social Security recalculates your benefit to account for the months that were withheld. Your monthly payment goes up to partially compensate. But in the short term, it can feel like punishment for working. And if you are not expecting it, the shock can be severe. The lesson here is to factor the earnings test into your planning. If you are still working and earning a solid income, it might actually make sense to delay survivor benefits until full retirement age when the earnings test no longer applies. That way you get the full benefit amount and keep your entire paycheck. The sixth error is an emotional one, but it has real financial consequences. Rushing major decisions while grieving. I say this with deep compassion. When you lose a spouse, everything feels urgent. The paperwork piles up. People tell you what you should do. You want to just get things handled so you can breathe again. But survivor benefit decisions are permanent. Once you file, once you lock in a certain amount, there is very little you can do to undo it. The choices you make in those first few months after loss will follow you for potentially 30 years or more. If at all possible, take time before filing. Not months and months, but enough time to understand your options. Gather information. Ask questions. Talk to someone who knows Social Security rules. Social Security allows you to apply for survivor benefits retroactively in some situations, so you do not always have to rush to file immediately. The key is knowing the rules so that grief does not lead to a costly mistake. This brings me to the seventh error, and it is one of the most expensive. Not realizing that survivor benefits and retirement benefits grow at different rates. Your own retirement benefit grows by 8% per year if you delay claiming past full retirement age all the way up to age 70. Those are called delayed retirement credits, and they can significantly increase your monthly payment. But survivor benefits do not work the same way. There are no delayed retirement credits for survivor benefits past full retirement age. Once you reach full retirement age, your survivor benefit is at its maximum. Waiting longer does not increase it. This creates an important strategic opportunity if your survivor benefit is larger than your own retirement benefit. You might want to claim the survivor benefit first and let your own retirement benefit grow, or if your own retirement benefit will eventually be larger. You might claim the survivor benefit early and switch to your own benefit later at 70. The right approach depends entirely on your specific numbers. But the widow who does not know this difference might wait until 70 for survivor benefits, gaining nothing extra, when she could have been receiving that money for years. Let me share one more story that brings this all together. Gloria lost her husband in early 2025. She was 64 years old. Her husband had a strong earnings record, and her full survivor benefit would be $2,500. Her own retirement benefit at 70 would be $1,800. Gloria's first instinct was to wait until 70 to claim anything, thinking that would maximize her income. But that would have been a mistake. Here is what made sense for Gloria. She claimed survivor benefits at her full retirement age of 67, getting the full $2,500 per month. She never claimed her own retirement benefit at all because the survivor benefit was already higher. If she had waited until 70 for survivor benefits, she would have received the same $2,500, but would have missed 3 years of payments. That is $90,000 she would have given up for no additional gain. Understanding the difference between how these benefits grow saved Gloria nearly $100,000. Now let me give you the clear action steps to avoid these errors. First, request a copy of your Social Security statement and your late spouse's statement if possible. Know both benefit amounts at different ages. Second, learn the difference between your retirement benefit and your survivor benefit. They are separate, and you may be able to claim one first and switch to the other. Third, calculate the break-even point for early versus full retirement claiming. Sometimes waiting makes sense. Sometimes it does not. The math depends on your life expectancy and financial needs. Fourth, ask about retroactive payments if you are filing after full retirement age. You may be entitled to up to 6 months of back payments. Fifth, understand the earnings test if you plan to work while receiving benefits before full retirement age. Factor that into your decision. Sixth, do not rush. Give yourself time to understand your options before filing. Grief is not a good financial advisor. Seventh, consider talking to someone who specializes in Social Security planning. A few $100s for professional guidance could save you tens of thousands over your lifetime. The Social Security system is complicated. It was built over decades with layers of rules, exceptions, and special cases. Nobody expects you to know all of it. But you deserve to know enough to protect yourself. You deserve to understand that the decision you make today will shape your income for years to come. You deserve better than walking into an office unprepared and accepting whatever they offer. If you are a widow or if widowhood is something you may face in the future, please take this information seriously. Write down the key points. Share this with someone who needs it. Come back to it when the time is right. The rules are complicated, but the principle is simple. Knowledge protects you. Understanding your options gives you power. And making informed decisions brings peace of mind. You have already faced something incredibly hard. Losing a spouse is one of life's greatest challenges. But your financial future does not have to be uncertain. With the right information and careful planning, you can secure the income you have earned and move forward with confidence. You are stronger than you know. And now you are also more informed than most. Take care of yourself. You have got this.